All right, today we're going to break down one of the most powerful and honestly kind of counterintuitive ways to use a health savings account, or HSA. It's a technique called the Shoebox strategy, and it has the potential to transform your HSA from just another account for medical bills into a secret, tax-free retirement machine. Let's dive in.
So, I'm going to start with a pretty bold statement. Every single time you swipe that HSA card to pay for a prescription or a doctor's visit, you are literally losing money. Now, I know that sounds completely backward. I mean, isn't that what the card is for? Well, yeah, but in this explainer, we're going to walk through the actual math behind that claim and show you exactly how much that swipe is costing you in the long run.
So, what's the secret sauce here? Well, the entire strategy is built on one incredibly powerful feature. The HSA is the only account in the entire U.S. tax code that gives you a triple tax advantage. Not a 401k, not a Roth IRA, just the HSA. And once you really get this, you unlock its true potential.
Okay, let's put these accounts side by side. With a traditional 401k, you get a tax break on your contributions, but you pay taxes when you take the money out. A Roth IRA, it's the opposite. You put in after-tax money, but then it grows and comes out totally tax-free. But look at the HSA. It's the only one with green check marks all the way down. Your contributions are tax-deductible, the money grows tax-free, and your withdrawals for medical costs are, you guessed it, tax-free. It is the perfect trifecta.
So, how do we actually take advantage of this triple tax power? Well, that's where the Shoebox strategy comes into play. Yeah, the name sounds a little old school, but the idea behind it is an absolute game changer. So let's walk through exactly how you do it.
Here's the game plan, step by step. First, you contribute as much as you're allowed to. Step 2, and this is absolutely critical, you invest that money. Don't just let it sit there in a cash account. Step 3 is the big twist. When you have a medical bill, you pay for it with money from your checking account, not with your HSA. Step 4, you save a digital copy of that receipt. Then, you just let your HSA investments grow and compound completely tax-free for years, maybe even decades. And then way down the road, whenever you want that cash, you can pay yourself back tax-free using that pile of old receipts you've saved.
Okay, that all sounds great in theory, but let's actually look at the hard numbers. We're going to run a simple scenario. We'll see what the real-world impact of this strategy is over a 15-year period. This isn't about feelings or opinions, it's just pure math. Let's imagine two identical families. Both contribute the max for a family, which is $87.50 a year, and both have about $3,000 in medical bills each year. We'll say their investments get a 7% average return. Now, the family on Path A uses their HSA card to pay those bills every year. But the family on Path B, they follow the Shoebox strategy, paying out of pocket and letting that whole HSA balance cook. So after 15 years, the family on Path A, the ones who just use their HSA like a normal debit card, they end up with about $144,000, which, is a pretty good chunk of change. Nothing wrong with that. But what could they have had?
Now let's look at the family on Path B, the ones who followed the Shoebox strategy. After those same 15 years, their balance has ballooned to $219,000. It's a massive difference just by changing how they paid their medical bills.
And the difference is $75,000. That number right there is the opportunity cost. That is the pure tax-free growth that vanished into thin air every time that HSA card was swiped over those 15 years. And just to really show you the raw power of this, look at this example. A single $5,000 contribution, if you just leave it alone for 30 years and it gets an 8% return, can grow to around $50,000. That's a 10x return, and because it's in an HSA, every single cent of that growth is totally tax-free.
But believe it or not, the HSA's power doesn't even stop there. Once you hit age 65, it unlocks a whole second superpower, which basically turns it into the most flexible retirement account you could possibly have. So after 65, your HSA becomes this dual threat. For any medical costs, and this includes your Medicare premiums, it's still 100% tax-free. Awesome. But let's say you want to use it for anything else. A vacation, a new car, whatever. It just acts like a traditional 401k, meaning you just pay regular income tax on the withdrawal. But, and this is a huge deal, unlike a 401k, there are no required minimum distributions, ever. You are in complete control. Okay, this is an advanced strategy, so to do it right, you have to follow the rules of the game. So let's quickly cover the fine print from the IRS, just to make sure you're doing everything by the book. The rules are actually pretty simple, but they are critical. Number 1, you can only pay yourself back for expenses that happened after you first opened your HSA. 2, no double dipping. You can't use a receipt for reimbursement if you already took that deduction somewhere else on your taxes. 3. You have to keep good records. And maybe the most important rule of all, the IRS has specifically said there is no time limit on when you can claim a reimbursement.
And this part is really, really important. As amazing as this strategy sounds, it is absolutely not for everybody. It really only works if you're in a specific financial spot and have the right discipline. So look, you should just stick to the normal way of using your HSA if you can't comfortably pay your medical bills from your regular checking account. If it's going to cause you financial stress, just use the card. That's what it's there for. This also isn't a great idea if you aren't the kind of person who can stay organized and save digital receipts for decades. And finally, if your HSA money is just sitting in cash and not invested, the whole growth engine of this strategy is missing, so it doesn't make much sense.
And to make this all super practical for you, here are the HSA contribution limits for 2026. If you have self-only coverage, you can put in $4,400. For family coverage, that number is $8,750. And don't forget, if you're 55 or older, you can throw in an extra $1,000 catch-up contribution.
So what's the big takeaway here? When you really look at the tax code and you run the long-term numbers, the conclusion is pretty clear. The HSA is the most powerful savings tool you have, but only if you start treating it like an investment vehicle first and a spending account last. Stop swiping, start saving. These aren't opinions, it's just the math.